Joining us now, Jordan Jackson, JPMorgan Asset Management Global Market Strategist. Jordan, great to have you with us. How important, if at all, is this jobs report, given we've already had a Fed meeting and we're already looking ahead to 2026?
I think it matters, but it doesn't move the needle all that much. I think the reality is the markets expect these numbers to be a little bit hazy, cloudy, right? Not clear data. But I think it's going to continue to confirm the story that we already sort of know, right? This is a labor market that is cooling, that's slowing, but one that's not breaking and collapsing to the point where the Fed perhaps needs to overreact here. And I think the Fed feels like they're in a comfortable position for the foreseeable future.
Let's talk about what's been going on in the past few weeks in terms of one of the biggest trades in the market, and that is AI. And it does seem like there is some skepticism creeping into this trade. We saw it in the Broadcom report, which is largely, in line. The backlogs were up, but still there was some questions about it. There are questions certainly about Oracle when you take a look at how the CDS has traded. How do you view the skepticism entering this trade and marry that to your outlook for markets in 2026?
Yeah, I think it's one of the risks to markets for next year. I think the AI theme has gone it will shift from being just this indiscriminate rally where everyone benefits to this period of deciphering the winners and the losers. And I think you will start to see more differentiation. But again, given the size of these names of the index, depending on the moves that some of these companies make, that could challenge the index more broadly to move higher over the course of next year. But I don't think it changed the broader narrative that we're still generally bullish, optimistic on the markets for next year after 3 consecutive years of double-digit returns. Now, does next year look like another 20% return on the market? Maybe not, but perhaps somewhere in the high single, low double-digit.
Do you feel like something changed, though? Because when Meta increased its CapEx forecast and said we're going to increase it significantly, the stock didn't react well. Whereas in the past, whenever these guys would say we're going to spend more, it was a positive thing. It seems like people are really questioning the spend, what we get for the spend, and whether that growth is going to continue at the same rate. I'm not saying that it's a growth rate that's going to collapse or anything to that degree, but even a slowing of an exponential growth rate is a disappointment for the markets.
No, I agree. I think there's always, it's appropriate to have some degree of skepticism. But I think if we're looking at this from a 3, 4, 5-year window, I think the bigger risk is to underinvest, not necessarily overinvest. So I think some of these numbers, it's being funded by cash flow. Obviously, we're seeing a little bit of debt, which is a bit of concern.
How about Meta with off-balance sheet debt?
From a company-specific issuer perspective, these are pennies on the dollar, right? So, companies still flush with cash. Now, my bigger concern is the impact that this could have on credit markets, right? Because you're seeing a lot of supply coming to the market, and that could cause some indigestion for spreads on a go-forward basis.
But when you look at this sort of prediction for next year, how concentrated is the success of the index going to be? Meaning, is it going to broaden out in a material way?
We think so. Look, the reality is it's hard to go from a $5 trillion company to a $10 trillion company. Maybe a little bit easier if you're a $1 billion company going a little bit multiples. But what I would say is we expect to see some sort of cyclical value areas of the market potentially providing some durability for a market rally over the course of next year. So we like financials, we like industrials, we like materials. I would say energy is a little bit of a wild card, particularly with our outlook for oil prices.
You're stating the scorecard that stands right now, though. Financials, industrials, materials, they've all been doing well this year so far. Close to records, basically. Yep. Energy, sort of wobbly, just the way they are right now. So is it just the same playbook as this year for next year?
I think it's a similar one because it's a backdrop where the yield curve continues to steepen out. We've gone from a deeply negatively sloped curve to a positively sloped one, and I think we're going to see the curve continue to steepen out over the course of next year. And that's generally been an environment that's been pretty supportive for a cyclical, value-orientated sector. As they also think the implications of the big, beautiful bill, being able to expense domestic R&D, I think we're going to get a little bit more of a more traditional CapEx spending on equipment and structures, alongside, obviously, continued very strong numbers on the AI spending side.